Welcome back. We're looking at an analysis of Plug's Q3 earnings. The argument is bold. A huge gap loss was actually a bullish sign of a structural turnaround.
It's a fantastic counterintuitive take, a bullish loss, and it rightly zeroes in on things like that $226 million non-cash charge. But when you have a thesis this explosive, the way you tell the story has to be absolutely perfect.
And that takes us right to our first critique. Optimizing the sequencing of that headline loss and how it's contextualized would, I think, really maximize the report's persuasive power.
I completely agree. The title is Q3 Earnings Shock, but the structure, it lets that shock, that $362 million loss, just sit there. It's uncontextualized for way too long.
Right. If I'm just skimming the headline numbers, I see that huge negative figure.
And you might just stop reading. You might never get to Section 2B, which is the whole key. The part that explains most of it was a non-cash write-down.
Exactly. And that delay, it just triggers a negative, almost emotional reaction. You risk losing the reader before you can even deliver the twist in your argument.
The goal here is psychological control. You want them to feel the shock, but you have to immediately turn that shock into relief.
Yes, the argument hinges on that non-cash charge flipping the whole narrative. So it has to neutralize the headline, well, instantly.
It has to. So the suggestion is to integrate that non-cash explanation immediately after you present the headline loss. You have to create instant relief.
And cement that fake loss idea right at the top.
The faster you do that, the more controlled and, frankly, brilliant the analysis seems. It positions the reader as an insider, someone who gets what's really going on.
So it's a structural fix, but one that completely changes the report's tone.
For sure. And for a concrete example, you could just reorder the bullet points in Section 1.
Put the massive gap loss right next to a little parenthetical note. Something like, includes $226 million in non-cash write-downs.
That little note acts as an immediate anchor. It neutralizes the fear from that big number.
Or, and maybe this is even stronger, you could move the whole section about the fake loss, Section 2B, so it comes before the part about the cash burn miracle.
Yes, establish the core premise first.
Right. The first big argument the reader sees should be the one that deflates the catastrophe.
That way, the frame for the entire report becomes, this wasn't an operational failure. It was an accounting cleanup, a strategic reset.
And that makes the reader an accomplice in the bullish argument from the start. Once they accept the loss was fake, they're primed to believe the cash burn reduction is the real story.
It changes the whole dynamic. It's not about convincing a skeptic anymore. It's about educating the reader on the truth behind the headlines. That's real narrative control.
A very strong point. Okay, let's shift focus now to the core of their strategy, this Project Quantum Leap.
The big pivot.
Yeah, the analysis does an excellent job detailing the shift-cutting, low-margin stuff like fuel delivery and going all in on high-growth electrolyzers, which, we're up 46% quarter over quarter.
And that shift is the bull case fundamentally. But to really insulate that thesis from skepticism, the analysis needs to address the execution risk a little more robustly.
The risk involved in such a big restructuring, right? And the heavy reliance on just one growth engine.
Exactly. The weakness, as I see it, is that the strategy is laid out, but the bridge to future profit is sort of implied, not really quantified.
We know they're aiming for positive EBITDA by the second half of 2026. But the reader is left thinking, okay, so how fast exactly does that electrolyzer segment need to grow to justify a $4 price target? Especially while they're cutting revenue elsewhere.
Right. Is there a risk here? I mean, everyone is focused on that amazing 46% quarter-over-quarter growth. But does that overlook the challenge of replacing the revenue they are intentionally killing off? If they're cutting billions in low-margin sales, that growth rate needs to be maintained or even accelerate just to stay flat.
So the concentration in one area becomes its own kind of risk.
A risk that needs to be acknowledged and quantified.
Okay, so the suggestion then is to introduce a clear analytical bridge, connect the cost cutting to the future revenue ramp.
Focus on the specific metrics needed for this pivot to actually work. You have to address the potential downside of putting all your eggs in one basket.
It gives the reader the full risk-reward picture.
And a concrete way to do this, look at that H2 2026 EBITDA target. After talking about the 46% growth, the report could, briefly model the required compound growth rate needed to hit that.
So, for example, if the trajectory requires, say, 55% year-over-year growth, and they're on a path that suggests that's achievable, you should say that.
Exactly. Or if there's a gap, you identify the gap. That transforms the analysis from just a story into a quantitative forecasting tool.
And if you can state that the current growth is already enough to hit that 2026 goal, well, that's one of the most powerful points you can make.
It becomes a huge confirmation of the entire thesis. And another example, define the new revenue mix target for 2026.
Show what percentage of total revenue electrolyzers represent now versus, say, a year ago.
Yes, that gives the reader a clear marker of progress. If electrolyzers are now 70% of the forward pipeline, where they were only 30% before, that's tangible proof that Project Quantum Leap is working.
And quantifying it provides transparency on that risk exposure we were talking about.
Right, that kind of quantification really bolsters the whole argument.
Okay, that makes sense. Let's move to our final area of focus, which is about the conclusion and the actionable forecast.
So the report does a good job wrapping up the kitchen sink quarter.
For anyone not familiar, that's just when management dumps all the bad news, all the write-downs, the restructuring costs, into a single quarter to clear the decks.
It's painful, but it's necessary. You reset expectations so future results look clean.
And the report rightly notes that because they did that, and because they slashed cash burn and got that big $370 million cash injection, they've bought themselves runway. That's a sound summary.
But then, the conclusion shifts. Very quickly. It goes right to a specific technical observation. Watch for a break above $2.05.
And while that cash injection absolutely kills the immediate bankruptcy risk,
A huge de-risking event.
the connection between that fundamental stability and that very specific 205 technical level is, well, it's implied. It's not explicitly proven.
We need to strengthen that linkage. So the topic sentence here is, strengthening the concluding market observation by directly tying the technical breakout level to the fundamental financial improvements would elevate the report's overall predictive power.
A technical investor or any trader needs to understand why this number matters right now, given the fundamentals have just been reset.
Exactly. The suggestion is to make sure that final observation is presented as a direct, logical consequence of all the financial changes detailed in the report.
The technical analysis can't feel like it's just tacked on at the end. It should feel like the market's natural reaction to the new fundamentals.
A practical fix for this could be to explicitly state that the $370 million in liquidity removes the immediate bankruptcy risk.
Okay,
Therefore, it resets the stock's fundamental floor above its previous lows. Then, that 205 breakout level can be framed as the market starting to price in this new, stable floor.
that's a very sophisticated connection. It's not just data points, it's market translation.
Right. Or you could tie the kitchen sink summary more closely to that technical forecast. The argument becomes, because management cleared all the bad news out, the market now has a clear runway.
So technical indicators, which can get totally thrown off by, existential risk.
They actually matter more now, because the underlying story is clean.
So a resistance level like 205 is suddenly vulnerable because the narrative that created it, the fear of bankruptcy, has been fundamentally destroyed by the cash injection.
And that gives you a powerful reason to include a specific technical level in a fundamental report. It's not just an appendix item anymore. It's a justified part of the bullish forecast.
This has been an excellent critique of what is, at its heart, a really strong analysis. The core thesis, that a massive loss was actually good news, is powerful.
It really is. The bullish loss idea is just fantastic. So, to recap our main points for improvement. First, optimize that opening narrative. Immediately contextualize the headline loss to turn that initial shock into relief.
Second, integrate a deeper quantitative analysis of the execution risk. Specifically, model the growth rate the high-margin segment needs to hit that 2026 profitability target.
And finally, strengthen that conclusion. Explicitly connect the technical breakout forecast, that 205 level, to the fundamental improvements and to the new stability floor created by that cash injection.
We're confident that integrating these three high-level revisions will maximize the power of this already impressive analysis.